morning, Lee. My name is Taylor, and on behalf of myself and my colleagues Heidi and Lauren, I'd like to start off today by thanking you for giving us the opportunity to work on our new clients, Western Beer Artisans Limited, Johnny Wall, and Bud Wilson. We think there are many exciting opportunities for how we can help them focus on continuing to grow their business by taking their minds off the tax implications of their business and setting it up in a way that is most advantageous for them. Today we're going to take you through their plans for the purchase of Don's Restaurant and Bar and how we can structure that most advantageously for them. We're also going to take a look at how they can compensate their general manager for Don's Restaurant and Bar in a way that will be both effective for them in incentivizing the manager, as well as give the manager the most tax-effective compensation method. We'll also look at some other business considerations for them going forward, most notably Shred, which we know they had some questions about, and whether or not they're eligible for it. Then we're going to move on to some personal considerations for the co-CEOs, Johnny and Bud. We're going to start off with Johnny, and we're going to look at setting up a spousal RRSP for him, as well as the farm losses he has. And then we're going to take a look at Bud and the business investment loss that he has, as well as the possibility of setting up an RASP for his current child and the one he has planned a few years down the road. After that, we're just going to run through what we think are the key next steps we need to communicate to our client, as well as what they should look at setting up and the order we would like them to do that. So to start off with, for structuring the acquisition of Don's Restaurant and Bar, there are two major ways that they could look at structuring this purchase. So this would be either through shares or through assets. Now, in general, sellers do prefer a purchase of assets through shares because they're able to use their capital gains exemption, and they're only taxed at one level. They don't have to be taxed for selling the assets of their business within the business, and then be taxed again for distributing that money out in terms of dividends. Buyers generally prefer a sale by assets because it gives them the chance to bump up the asset value, which maximizes their depreciation they're allowed to claim. They don't have to buy any liabilities. They get more choice over what they actually buy from the business. And they're also able to carry, but unfortunately they're not able to carry forward any of the losses from the business. So that being said, in general, the share sale does benefit the seller, and that is the seller's preference. However, given the circumstances, a sale by assets can be performed as well. So now taking a look at this specific case, we have, from the point of view of Don, the seller, this is what his sale of shares versus assets looks like for him. So as you can see going down, we did have to make some assumptions, but we started off with his income from the sale. So that's the assets. We had to do some assumptions with his current fair market value of assets. But then moving down, you have the taxable proceeds. The most likely ways he's going to distribute that income from the business. So starting with either his capital gains exemption or his paid up capital. Look at the remaining proceeds he has after, as well as his after proceeds. Now we can see that for Don, it's basically $300,000 better to conduct a sale by shares. Now, comparing this to our clients, Johnny and Bud, the buyers, we just wanted to take a look at what their benefit is from buying with assets as opposed to shares. So you can see moving down, we have the cost, again with the assets, their planned capital expenditures, as well as the liabilities they'd be acquiring. So essentially, what is their economic cost of an acquisition by both shares and assets? Through this, then we've had to make some assumptions about the tax shields they'll be able to claim after that. So we've used 9.7% just sort of as an average CCA rate of what we think they might have in terms of assets, as well as the loan they were going to use to finance the purchase, and that was, we just assumed 10%, because we're not really sure about an in-depth look. We would need to take a more in-depth look at the financial position of their businesses. So this gives them an after-tax cost, which is approximately $56,000 better if they acquire through assets as opposed to shares. Now, seeing as how it's the benefit for the seller from doing the acquisition through shares as opposed to assets is so much greater, there would likely be some negotiation or costs that would have to go into, so you might have to pay more if you would like to do the acquisition by assets. And in order to determine if that's really worth it, we need to get more into due diligence, realize whether if there's actually that much of a benefit for purchasing by assets as opposed to shares. So moving on, we have our proposed corporate structure for after the acquisition. So you can see at the top we have or just start moving from the bottom up, actually, we have the current company, Western Breweries Limited, and the Don's Restaurant and Bar down at the bottom. We have these left as two separate companies owned by a holding company. Now, the reason we left these as two separate companies is to make it easier to compensate the GM, their general manager they're looking to hire, both for Don's Restaurant and Bar currently and for Western Breweries in the future. This will make it easier to split off some shares for the manager to own as opposed to having them own like their compensation tied to only one business as opposed to the other when they are actually owners of both business. That would get a lot more confusing. And then we have these owned by the holding company once again. And the reason for the holding company is it gives the opportunity for them to defer paying taxes on dividends that they might want to pay out in order to keep their businesses eligible as a qualified small business corporation. So if they get too much cash in the business, we want to let them know that this holding company is there in order for them to send that money out somewhere else and preserve the status of their business as a qualified small business. Now above that, you can see we have the whole holding company owned by two family trusts, which we would also like to advise that they set up. And the reason we've looked at having this holding company owned by the family trust is down the road, it gives them the opportunity to maximize the use of their capital gains exemption. Now we've assumed Bud and Johnny have maybe a limited knowledge of what the capital gains exemption is. We need to do a bit of a discussion with that about them, whether they realize that they actually are eligible for have $750,000 of capital gains they don't have to pay taxes on when they sell shares of a qualified small business corporation. Now the reason we have advised them to do this through the family trust, or we would like to advise them to do it this way, is by making their wives and their children, when they're over the age of 18, beneficiaries of the family trust. You're able to utilize more than one capital gains exemption on the sale. So you'd be able to use the wives and the children when they're over 18 years of age. We'd have to make it really clear with the children over 18 years of age, because if they're under 18 years of age, all the income will be attributed back and there will be some taxes on that. So right now I'm going to pass it on to my colleagues to let them discuss how we want to look at compensating the general manager.
Thanks, Taylor. So I'm just going to get into some of the compensation strategies we have for compensating that general manager in order to provide them with an equity stake and also considering some tax implications for those strategies. So the first one I'm going to outline here is that loan that Bud and Johnny have actually outlined, which was the $55,000 in order for them to buy a 5% equity stake in the company. Now, the CRA would recognize this interest-free loan as a taxable benefit. So it's important for the general manager to include 1% interest rate, the current prescribed rate in the Income Tax Act, in his income for the year. And we actually calculated the present value of that imputed interest taxable benefit to be about $5,210, assuming the rate stays at its current rate. Now, this loan, because the manager would have a 5% equity stake, it would really incentivize him to work harder within the company. However, it does have a downside because the business valuation would likely be required in order for the general manager to purchase these shares at a fair market value. And we also noted that there was no control over the voting rights for this company, for this structure, pardon me. Now, we also looked at a different option, which was issuing new shares at a nominal value. And this one actually is quite beneficial because there would be taxes paid on the dividends and the capital gains. And like I said before, the manager would be incentivized to really see the growth in the corporation. And there's also minimal need for external business valuation, which would minimize the cost to Western Breweries artisans. Now, these shares would be issued at nominal value, so no loan would be required. And we know that that was something that Johnny and Bud were really concerned about, was that the general manager wouldn't have enough capital at this moment to invest in the company the way he would like to. And last, this option would provide control over voting and rights. So because perhaps they wanted to issue it as a new class, they would be able to say issue preferred shares, which could then be convertible to common shares. The last option that we've outlined is a stock option benefits plan. Now, taxes are paid out on stock option benefits, on the dividends and the capital gains, as well as on the stock option benefit itself. Because WBA and DRB would be Canadian-controlled private corporations, the benefit would not be taxable until the time of sale, which provides a little bit of flexibility in terms of deferring taxes. As well, deduction 1110D would apply if the shares were held for longer than 2 years, and if the stock option benefit, if the shares were issued at or out of the money. And like I said, the manager will still be incentivized because he'll have some share within the company. And similar to the option of the loan, you'd have to incorporate a valuator into the company, which would be, again, that cost for the company. So we've outlined a little matrix here just to outline those options and see which one is really, we found, had the best value for WBA and DRB. And as you can see, the only one that was able to be affordable for the general manager, be tax effective for him as well, or her, as well, in all 3 options, you'd be able to use your capital gains exemption, provided the company maintained its status as a qualified small business corporation, and also incentivized the manager was that of the nominal shares value. Another issue that I want to speak to is that of Johnny and Bud not sure if they should compensate themselves through dividends or through a salary. Now, a salary is taxable as income, but it is deductible to the company as long as it is paid at fair market value. Anything higher than that will be screened by the CRA and will not be deductible. Now, in terms of dividends, they're taxable as property income. They would be grossed up and included in income with an additional tax credit. And through the concept of integration, we can actually see that they'll have approximately similar tax treatment. Now, when you're explaining this to Bud and Johnny, it would be helpful to use an example because it can get kind of complicated. So you could say, pay yourself $1 in salary and try paying yourself $1 in dividends. The $1 in salary would be included in your employment income, and the $1 in dividends would be grossed up by this year's current rate, by 2013's current rate of 25%. You get $1.25 included into your income for the year, and then you would also be eligible for a 13.33% tax credit. You'll notice in the end that you have an approximately same tax treatment when opposed to paying the same taxes. So now I'm going to pass it off to Lauren, who's going to speak to some other business considerations as well as Bud and Johnny's personal tax issues.
So from the notes that you gave us, I know Johnny and Bud were kind of curious about the scientific research and experimental development opportunities that the government provides. And at first glance, from the notes you gave us, it doesn't quite look like they'll qualify. However, in the meeting with Bud and Johnny, we really want to have a discussion on, go into a bit more detail on how they developed their process. And was it innovative or proprietary in that industry? In which case, if it is, they could deduct those expenses from their income, as well get an investment tax credit, which is where the real benefit comes from. So they could get that 35% tax credit on the first $3 million of expenses that qualify for SHRED. And the best part about that tax credit is part of it's refundable. So they could get instant cash back if they don't have enough tax liability to apply against. So for their current expenses, they could get 100% refundable tax credit, but if it was capital expenses, about only 40%. Now there are current changes in 2014 in the SHRED, such as after that $3 million, it's going to be reduced from a 20% tax credit to 15%, and there's a few more changes with capital expenses. However, I don't think we really need to go into detail with them about that. We just want to outline the main benefits for them. As well as talking about past expenses that they incurred, we want to make sure they're aware of this because of potential future possibilities. They're expanding their business, they're really passionate about brewing, and they may want to consider investing in researching for a more effective process or a very innovative process in their industry. Now, we looked at Johnny's personal considerations first. We know he had some issues with farming losses, as well as we think there's an opportunity for a spousal RSP. So first, to address the farming, because it's not his primary source of income anymore, we realize that the loss incurred of $2,500 will be a restricted farm loss. However, even though he didn't get to plant any crops this year, he fallowed the land, we believe there is a better expectation of profit in the future. So he's going to be able to use that restricted farm loss against all sources of income, as opposed to just income from the farm. If he didn't expect profit, you would only be able to use that loss against your company. As well as the $2,500, the first $2,500 of expenses. For the next $12,500, he can use half of that as a loss, which is another benefit for him. In regards to maybe splitting income between him and his wife, especially in the future, we want him to consider a spousal RSP. She's currently a teacher, and while that's one of the most admirable careers that you can imagine, I know that their salaries aren't that great. And so her contribution room and her RSP will be a lot smaller than what his is. So in the future, we want to make sure that when they retire, they have as much income as possible. So we want to split the income between the two of them. He can use the contribution room that he has and actually contribute to her RSP. He will also be able to take the deduction on his income, which again will reduce his taxes even further. The one thing we should make sure he's aware of is that his wife can't withdraw that money within 2 years after that contribution, or else the income will be attributed back to him. Definitely don't do that. For Bud, we also saw 2 opportunities for him to improve on his family taxes and really save for his kids and provide as much opportunity for them as possible. First of all, he had that $55,000 that he invested and pretty much lost all of it. And he didn't actually do anything with that on any of his tax returns or take advantage of it. It's actually going to be considered an allowable business investment loss because that consulting business was a small business. The government wants to provide more opportunities and more incentive for people to invest in small businesses. So for that $55,000, he's going to be able to apply that against all sources of income for the first 10 years. Unfortunately, he used up 1, but he can carry it back 3 years and carry forward another 9. And then after that, it will be changed back into a capital loss, so we'll only be able to apply it against capital gains. The main point I want Bud to understand is he needs to set up an RASP for his children. I know his first child's only 3 years old, and his second child is yet to come, but we want to make sure his family has the best opportunity possible in the future, and we want to make sure his kids are going to be well provided for in their education. So the RASP is a registered education savings plan, which is one of the best things that the government has created, in my opinion. It's a tax-effective way to set up an education fund for his kids. He's going to receive tax-free growth until they have to withdraw that money. And when it is withdrawn, if it's going towards his children's education and his qualified education system, then it's going to be taxed as a child out of his parents. If it's not a qualified education, it will be taxed in his hands. However, he did receive that tax-free growth. The RASP will also be eligible for the Canadian Education Savings Grant and the Saskatchewan Advantage Grant for Education and Savings, which is free money from the government. Now, some of the key takeaways. Most likely the purchase of John's Bar will be purchase of shares. We're going to set up a trust and holding company, as well provide nominal shares for the manager, and get the 2 of those guys to set up an RASP and a spousal RSP. Our next step, we'll have to run through John and Bud with them in the next meeting. We're going to have to help them create this structure. We're going to have to help them set up the holdco and the trust. And once again, I just wanted to thank you for giving us this opportunity to really show and provide the quality that our firm can provide them, and really give them the opportunity to focus on their passion. Thank you so much.
Thank you. This concludes the presentation. The question and answer period will now begin.
Johnny's farmland, how would you deal with that?
In which way?
In the sale of his farm?
Oh, the sale of his farmlands? I know the sale of farmlands can get quite complicated. I know there's specific rules available if you're selling to family. However, we probably want to consult with someone who had a bit more specialization in dealing with those transactions with farmlands, just because the rules do intertwine to get a little complicated when structuring.
So with the recommendation of having the 2 separate operating companies, 2 different locations, how can we kind of move money between them or reinvest? With surplus cash in one and we need to reinvest in the other, what would you suggest? How would we move that?
be like a fair market price. We'd have to make sure everything is in accordance with CRA. Another way we could think about it is providing a loan to one company and then having that company pay interest back, which could move some of the profit from one company to another. As the city's booming and the industry future looks great, we don't see a future prospect of one company being in a loss position, but those are options that we can talk about in the future.
So in summary, what was your decision on the salary versus the dividends? Which one do you think would be more appropriate?
Yeah, so as of right now, we think that Bud and Johnny should continue to pay themselves a salary because that will be deductible to the corporation as long as it's at fair market value. However, as they move forward and look to retire, the fair market value of their salaries will go down because they're taking a back seat in their company. And they can make up for this deficit, if you will, in their salaries by paying themselves dividends, as Taylor outlined through their holding company, would provide a layer of cushioning and more flexibility with the timing of the payment of those dividends.
And are there any maybe potential RRSP implications of having a salary paid to the owners versus a dividend?
Yes, so one of the reasons we want them to keep paying themselves a salary is to keep that contribution room coming. Because they're only going to get contribution room of 18% of the previous year's income, or as of 2013, it was a maximum of 23,820. And because we're going to recommend that spousal RSP, John really needs to keep that contribution room coming.
Good, thank you.
Currently, like we have Western Garrisons, you advise that we should set up a hold co. How do we move Western Garrisons into that hold co? Like, can you elaborate on that transaction?
So that would be a rollover. So they both currently own the shares in WBA. What would happen is they set up the holding company. They'll transfer their shares so that the disposition of their shares would be at their adjusted cost base. And when it's rolled into the holding company would have an adjusted cost base equal to what their adjusted cost base would have been. Therefore, they won't have to be taxed on any capital gains.
Is there, with a smaller business like this, I understand there's a preferential tax rate available below a certain amount of income, and you can maybe allocate that across companies. How do you propose to deal with that?
So what you're talking about is the small business deduction, so that gives them a lower tax rate on the first $500,000 of income. And the way that preferential tax rate works is there is one preferential tax rate for the first $500,000 for every associated group of companies. So regardless of how we really structured the transaction, since they're both owned by the same people, they're only going to have that limit set at $500,000. The